Welcome to this explainer. Okay, let's dive right in. Today, we're tackling one of the most notoriously confusing, heavily misunderstood, yet absolutely crucial concepts in financial statement analysis: deferred taxes. If you're preparing for your CFA Level 1 exam, or even if you're just looking to truly understand how companies report their earnings versus how they actually pay their taxes, you are exactly in the right place.
Now, I want to start off by posing what I call the ultimate accounting paradox. It's the question that trips up almost everyone when they first stare down an income statement. If a company officially reports that it made exactly 100 rupees in profit, why on earth isn't it taxed on that exact 100 rupees? Where does that mismatch actually come from?
Well, to answer that, here's our roadmap for today. First, we'll cover the great timing difference. Then we'll break down DTL and DTA. After that, we'll jump into a real-world manufacturing case, listen in on a CFA study group breakdown, and wrap up with some crucial CFA exam pro tips.
All right, let's start right at the foundation with Section 1, the great timing difference.
So, the core of the entire deferred tax puzzle really just comes down to this. We're dealing with two completely different rule books that serve two completely different masters. Accounting rules, they want to show the true economic reality of a business to investors. But tax laws? Yeah, the government doesn't care about a beautifully nuanced economic picture. They just want their money, and they want to calculate it right now using standardized rules. Because these two rule books recognize income and expenses at completely different times, your accounting profit is practically never going to equal your taxable profit.
So the crucial point here is categorizing these differences. They basically fall into two buckets: temporary and permanent. Temporary differences are purely a matter of timing. A mismatch happens today, but it completely reverses in the future. This right here is what creates deferred taxes. Permanent differences, on the other hand, they never reverse. For instance, if a company pays a legal penalty, the accounting books record it as an expense, but the tax authorities are absolutely never going to let you deduct a penalty. There's no future reversal, which means permanent differences create zero deferred tax. For this topic, you can just completely ignore them.
Okay, with those foundational rules established, let's move into Section 2, DTL and DTA explained.
Let's look at a really simple conceptual breakdown to show you where deferred taxes actually live. Imagine your accounting profit is 100 rupees, but according to the tax laws, your taxable profit this year is only 70 rupees. Assuming a 30% tax rate, you're only paying 21 rupees to the government today. But based on your accounting profit of 100, your tax expense should be 30. So the difference between the 30 you should pay and the 21 you actually pay is 9 rupees. Now, that 9 rupees isn't forgiven, it's just delayed. You're definitely going to have to pay that extra tax in the future.
And that brings us exactly to our first major definition, a deferred tax liability, or DTL. A DTL arises when your taxable income is less than your accounting income. It simply means you paid less tax today, so you're just postponing that tax. You will absolutely have to pay it later. A good trick? Just think of the L in liability as later. You owe it later.
Then on the flip side, we have the deferred tax asset, or DTA. This happens when your taxable income is actually higher than your accounting income. You end up paying more tax today than your accounting books say you should. So why is that an asset? Well, because paying extra today actually creates a tangible future benefit. You've essentially prepaid some of your tax, meaning you're going to pay less in the future.
Now, I know definitions can feel a little abstract, so let's jump into Section 3, a real-world manufacturing case, to see how this all plays out.
Picture a bustling manufacturing plant. Let's say the company just bought some massive, heavy machinery worth 10 lakh rupees. Now, think about how the two rule books handle the depreciation for year one. The accounting department uses straight-line depreciation, recording a nice, smooth 1 lakh rupees expense. But the tax authorities, they often allow accelerated depreciation to encourage business investment. So the factory's tax return shows a massive 3 lakh rupees expense in year one. Because that tax expense for depreciation is so much higher today, the taxable profit is suddenly way lower than the accounting profit. The company ends up paying significantly less tax to the government this year. But remember, the total depreciation over the life of the machine is still just 10 lakhs. Since they took a huge chunk of it for tax purposes right now in year one, they'll have much less depreciation to claim in the future, which means their taxable profit will eventually jump back up and they'll pay more tax later. So this situation perfectly creates a deferred tax liability. The tax is just postponed, folks, not avoided.
All right, let's transition into Section 4, the study group breakdown. I want to take you to a coffee shop where 4 friends are prepping for their CFA Level 1 exam. Hearing this discussed peer-to-peer is honestly one of the best ways to lock this concept in.
So we start with Rahul. Rahul represents anyone who's ever stared blankly at a balance sheet and just felt totally lost. He kicks off the study session, rubbing his temples, and asks the ultimate elephant-in-the-room question. Man, I just don't get it. What actually is deferred tax?
Priya immediately jumps in to simplify things. She leans over the table and brings it right back to basics. She says, it's simple. Profit is one thing in the books and completely different for tax purposes. Remember that depreciation example we just went over?
Then Aman drops the golden rule. This is exactly how you want to memorize it for the exam. He says exactly. If you pay less tax today, it means you'll pay more in the future. That creates a DTL. And remember, permanent differences do nothing. We only care about temporary ones.
Next, Neha neatly completes the framework by adding the complementary rule. She points out, and on the flip side, if you paid more tax today than your books show, you get a benefit in the future, which creates a DTA.
And right there is Rahul's light bulb moment. The pieces finally connect, and he realizes, so it's really just a timing game. Now it's clear. Deferred taxes aren't some dark accounting trick. It's literally just future tax tracking.
Rahul's breakthrough perfectly sets up our final section, CFA Exam Pro Tips.
Aman shared these 6 rapid-fire tips with the group, and trust me, they are absolute gold. First, always ask yourself, will this reverse in the future? If yes, it's a deferred tax issue. If no, ignore it entirely. Second, depreciation is the most frequently tested topic here, so know it inside and out. Third, use the shortcut, less tax today means DTL, more tax today means DTA. Fourth, you absolutely must practice the numericals. They're going to test both the concept and the calculation. Fifth, always link it back to cash flow. A DTL represents a future cash outflow. And finally, number 6, don't overcomplicate it. Just remember Rahul's realization, it is just a timing difference.
So why does all of this matter outside of just passing an exam? Well, because deferred tax helps you understand a company's real future tax burden and its true profitability. It has a massive impact on projecting future cash flows. Savvy analysts look closely at deferred taxes to detect aggressive accounting practices or potential earnings manipulation. It literally tells you if a company is truly performing well or if it's just coasting on a temporary tax holiday.
Which brings us to our final thought. Deferred taxes really aren't complex. They're just completely misunderstood. Once you grasp the idea of timing differences, you unlock one of the most powerful tools in financial statement analysis. So the next time you're analyzing a company's earnings, I want you to ask yourself, are you just looking at the accounting trick or are you tracking the future tax? Keep that focused mindset and you'll be well on your way to mastering financial analysis. Thanks for joining me in this explainer and keep learning.